All right, good afternoon, everyone. Futures Brizio here. It is it's about quarter to five on Thursday, September 11th, 2025. Hope everybody's having a great day. And before we get started, as always, make sure you smash that like button, subscribe to the channel, and any questions or comments, leave them down below. Really appreciate the support. And we'll just jump right in. Uh, Now, I have tried to make this video 3 times in the last couple of days because I keep having some issues with my recording software and my camera and all that. So I think I have it worked out. So I'm going to try it again. And the most frustrating thing about this is re-recording it is that it's actually one of the longer videos that I've done recently. So to have to do it 3 times in a row is kind of crazy. But I'm hoping that third time's a charm here. So we'll just jump right in. So first of all, this is going to be a discussion for those of you that trade futures or want to trade futures or have thought about it, and preferably those who are swing traders. Not that you can't do this as a day trader or a scalper, but the most benefit for this probably comes from swing trading, and as you'll learn why as we get into this. So we're going to talk about commitment of traders. This is not anything new. This is a way of adding a fundamental element to your analysis and your trading. It's not a trading system. It's not even a timing thing. But as you will get into this here, and I'll talk about what it is and what it's not, you'll see hopefully how you can work some of this into your analysis in terms of trade direction, give you a little bit more surety about the direction you're trading. I mean, nothing's guaranteed. And, even with this information, you're still going to have losses. That's just a guarantee in any trading system. But this is pretty cool data that you have access to as a futures trader that people, a lot of people don't even know about probably, and they're just trading off technicals and chart patterns, which, that's pretty much what I talk about on this channel. But this is something that I use too. And I've kind of started reincorporating even more recently. And it does take a little bit of patience, and we're going to get into it. So this is, again, called Commitment of Traders. This is an official government report. It comes out once a week. It's published on Friday based on data that is released to the CFTC on Tuesday. So from this past Tuesday, 2 days ago, the data is locked in. And then tomorrow afternoon on Friday, they will update this report. So it comes out once a week. And again, this is the official government website here in the US. It's cftc.gov. And you go on here and you go into market data and analysis, and you go to commitment of traders, and it will bring you to this page. Now we're going to go over what's on here briefly, and then I'm going to show you an easier way, I think, to look at this data, because the way they publish it on here, it's not very user friendly. But I wanted to show you where it originates from and what it is if you're not familiar with it. Now, I would definitely suggest that if you don't know what COT is, that you spend a little bit of time on the website. They do go through a lot here about, what COT is, how they classify it in terms of the groups of traders. There's some FAQs and the types of reports. So, this is a good website, and this is, right from the CFTC. And this is information that large traders are required to report to the CFTC, and that's where all this data comes from. Okay. Basically, what it tells you in a nutshell is what is the net holding positions of certain groups of traders. And the main 3 groups of those traders, as we're going to look at, are what we call commercial traders or producers, and then the non-commercial large speculators, and then the small speculators or non-reportables, which is you and I as retail traders are included in that group. So think of your producers and commercials are like, if you're a sugar farmer, you're producing, sugar, which is a futures commodity, right? you're in that producer commercial. And then let's say you're a food company that buys that sugar to put into products, right? You're also a commercial trader, right? So you have an interest in the price of sugar for your selling, for your business, and for production of goods and goods in this case, okay? Then your large speculators, your non-commercial large speculators are your investment houses, right? Your brokerage, your hedge funds, your just super large traders that are trading a lot of money. They're speculators. They're in it to make money. They're like you and I, just on a very grand scale, right? So that's kind of the second category. And then the third category, like I said, are you and I, they consider the others, non-reportables, small speculators. You'll see it go by different words, okay? Now, they have since broken it down a little bit more, and that's what they call the disaggregated futures, where they basically added like a fourth category, which they call swap dealers, which are basically middlemen in between the commercials that work. They're not quite commercials and producers, but they kind of work in that arena. And so there was a lot of yelling and screaming from the market, saying that there were certain people that were being included either as non-commercials or in the commercials that shouldn't have been. So the CFTC created this fourth category called swap dealers, which if you ever see, there's basically you'll see like two types of reports. You'll see the disaggregated report, which shows you that additional category. And then the one that shows the original three categories only are basically what they call the legacy COT reports. And that's primarily what we're going to focus on. So on the CFTC website, you'll see they have, some general categories right here, and they have long and short format, and they're showing the disaggregated one here. And so basically, when you open this, and I'm just going to open the short format one. I know you can't see all the way over the left side of my screen. I wish I could fix that, but I can't now that I'm recording. But it brings up a table like this. And let's just focus off to the left where you can't see. So you see these headings. So this is the market, and this happens to be wheat. I know you can't see it, but off to the left here, it's Chicago Board of Trade wheat. And it tells you the contract size, which is 5,000 bushels. And then across the top here, it has the different categories. So it has producers here, which I know you don't see. Swap dealers, that's that new category. Managed money, those are your non-commercial large specs, and then the UNIs, the other reportables. And what it shows is their net positions, long and short, and the total open interest, which is basically the total number of open contracts for this commodity. And so I know you can't see the producer, so we'll just look at managed money. So in this particular asset, the large speculators have 91,577 long positions. They have 174,853, okay? And there are other reportables, which you can see these numbers here. And then underneath here, it shows you the change from the previous report, which was on August 26th. This was the report as of September 2nd. Like I told you, a new report will come out tomorrow that reflects the data as of September 9th, which was Tuesday, okay? All right, so this will update tomorrow, but as of right now, this is still the current report. And then it shows you again, so what the change was from the previous report. So if we just look at the managed money here, like I said, they were at 91,577 longs. That's down 2,802 from the previous week. And they also reduced their short positions by 2,385. Okay. All right. And spreading basically means, where they're basically playing, both sides of it. Okay. So we don't really worry too much about spreading. These are the numbers that we worry about right here and the change. And we're going to look at that in a easier format later, because you got to know what to do with this, right? And then there's some other data on here, which not as important. And so you scroll down here, and this is the agricultural market. So we got wheat, we got different types of wheat, spring wheat, winter wheat, and we got corn, rice, and then we go into our ag products, hogs, cattle. I know you can't see all the way to the left, but if you go there, you'll see these charts. Okay, so that's like the table format. Not very easy to read. And so, then if you scroll down here, these are the legacy reports. Remember, I told you about the ones where they don't have that new category. So this is another place you're going to see this same data. You're just not going to see, that swap dealer section, right? You're just going to see the three main categories: the commercials, non-commercials, and small speculators. All right, and these are the various exchanges that they're found on. And you can download this stuff. They let you download it to like a comma delimited version, which is like an Excel spreadsheet. There's no reason to do that. I mean, I don't know what you're going to do with that data unless you're, doing other analysis. But anyways, this is where it comes from. That's what it shows. And the reason why is because the CFTC requires these large producers and these large speculators to report their positions because they are so market moving. They want to know who's in the market and what they're doing. Okay, so for whatever you think about that, it is what it is. The reports have been around forever, for decades. They've been tracking this data. Okay, so it's nothing new. You and I, as individual small speculators, we can't move the market. Regardless of how big your personal account is, you're not moving the market, right? So they don't care. We don't have to report. So that's why they lump us just into that other category, okay? Because we don't do nearly enough volume to move the market, okay? All right, so that's what it is. That's where you find it, and that's what it's comprised of. Okay, well, the next question is, well, how do you use it? Well, there are various websites, and I'm also going to show you on TradingView. There's an indicator on TradingView you can use. Actually, there's multiple ones, but they all pretty much show the same thing. Where you can see this in like a graphical form. So over time, you can see the changes in it. Now, the reason why I said that, you have to look at this as more as a swing trader is because, as I mentioned, it only changes once a week. Okay, that report only updates once a week. So whether you're looking at these tables or you're looking at some graphs on a website or a TradingView indicator, it's only changing once a week. So if you think about like a battleship out on the ocean, or a cruise ship, right? If it's going north and all of a sudden it needs to turn and go south, can it just like on a dime turn around and go south? No. It takes a while to slow the boat down, start to slowly turn it, and then eventually start going in the other direction. So think about that in terms of these large, gigantic traders. They can't just all of a sudden switch their positions. Because first of all, if they did that, they would disrupt the market. They wouldn't be able to get, their orders filled. That's why we talk about, them slowly building positions, liquidity concepts, all that stuff, right? That's why they do it, right? Because they're so big. And it's also because they react to things going on in the market. If you're trading corn and soybeans and wheat, stuff like that, well, what do you think one of the big factors are that affects the pricing of those products? Yes, it's the demand, but what else? Okay, well, in the case of things like agricultural products, it's the weather, right? And there are seasonal patterns to that too. And I'll also show you how you can also add in a seasonality aspect to this too. And so it takes a long time for this to change. So that's why if you're trading this as a day trader or a scalper, I'm not saying you can't do it, but it's probably not as relevant, mainly because if you're a scalper especially, but even a day trader, you're trading, little bits and pieces of the market every day, and you don't necessarily need to know what the long range direction is, because you could be trading a pullback if the market's bullish and going up, but you're trading on a 5-minute chart and a particular day it's in a pullback phase. Well, you're selling the market that day. Well, overall the market's in an uptrend, but you're just taking out a little piece of that on a really short time frame. Now, if you take a trade in the direction of the longer time frame based on this data, that gives your trade even more surety and a little bit more stability, and maybe you can hold that trade a little bit longer. But you get the point, right? So this is for people that want to I don't have time to look at charts all day. I want to be able to take a position and maybe hold it at least for several days. Okay, that's what a swing trader is. You're holding positions between the different trading days, right? You're swinging from one trading day to the next, from Monday to Tuesday to Wednesday, from one week to the next. Okay. And so in that respect, it's more apt for swing traders and position traders, and maybe not so much for day traders and scalpers. Okay. Again, not that you can't benefit from this information too. It just, because you don't want to get stuck, on that day when the direction does shift, because there is going to come a time based on what these large traders are doing that the market is going to turn one day. And this can give you a big heads up about approximately when that might start to happen. Okay. That you wouldn't know ordinarily. So, all right. So that's kind of the setup for it. So the first thing I'm going to do is we'll go to Trading View, and let's see here. Okay, so here's Trading View, and I'm going to go out to the weekly chart. You can see I have a position open right now in corn. Market's closed now, but that's why this is not moving. But let's go to the weekly chart, and we'll take a look. Okay. Now on this is the index. This is called COT index. So if you go and you just type in under indicators COT index, okay, I think it's this one right here. There's a whole bunch of them, as you can see. They pretty much all show the same thing. But if you want to, check, and these are all, free indicators, custom indicators that are in their files. Hey, go have at it, check out the one that you like and use it. So this is the one I picked. I left all the default settings on this, which is basically, the only thing I did is untick the visibility. I don't need to see this on anything except the daily chart and higher. And really, I don't even need the daily chart to show this. But as far as inputs, it's a 26-week look back period, which is pretty good. 6 months, I think that's pretty good. And then these thresholds on the chart, the green and the red, are set at 80%, 20%. I left that as it is. So I didn't really change anything other than the visibility. Okay. All right, so what are we looking at? So the blue line are your commercial traders, okay? And the red line, I think it's the other way around. No, I think that's right. Yeah, the blue line are your commercials. The red line is your producers. Your non-commercials, your large speculators. Oh, that was the one thing I did take off. Small speculators, I unchecked. I don't care about the small speculators, you and I. It makes no difference. So I unchecked that. I don't need to see that. So I only want to see the commercials and non-commercials. Now, you will notice almost right away looking at this. I don't know if you can pick up on it right away. What is the relationship between the commercials and the non-commercial positions? Okay, if you look at this. In almost all cases, not 100%, but most often, you are going to find that they're at opposite sides. They're a mirror image of each other, particularly when it comes to when it comes into the extremes, like where we are right now. The commercials are showing in this extreme overbought area, or overly long. I don't want to call it overbought because it's not like it's RSI, all right. But they're in this extreme long zone, and the non-commercials are in this extreme short zone. Okay. There are times when they're about the same, like right here, but you can see they're always kind of mirror image of each other. So some people advocate, so then why do you even look at the commercials? Just follow the non-commercials, because we basically want to follow the big non-commercial, all right, because they're the large speculators. But I like to look at both, mainly because it doesn't always fit that they're mirror image of each other. Okay, so I do like to look at both, and I am looking for times when prices are at extremes. But again, that's not going to happen very often. So there are ways to trade this, even though it's not at an extreme. Okay. And you're like, well, why are they at extremes? Well, you got to remember the reason why they're in the market. If you talk about the commercial producers, they're hedging against risk. So they, at some point, want prices to go up, and then they're going to distribute, and then they're going to start hedging against the non-commercial traders. And so they're going to be opposite of each other. I mean, they they're basically the yin to the yang of each other. So that's why you're going to see, because again, they have different reasons for being in the market. These guys with the red line, the non-commercials, they're in it strictly to make money. Okay. Well, the commercials and producers are too, but they're also hedging risk. So they're taking kind of almost like the opposite side of where the large speculators are pushing the market. So that's why you often see these extreme positions opposite of each other. That is by design the way they trade. And you'll see that pretty much in any market you look at. Okay. This happens to be corn. Even if you look at oil, you can even trade COT on indexes on like the S&P and currency futures. All right. You're going to see the same type of setup. All right. So what can you do with this information? Remember that you can't just take a signal on this because this is a weekly chart. So your analysis is going to start here to say, okay, where are they positioned right now? Now, for the case of corn, this is a really super interesting place right now, which is why I'm using it. Because you can see what happened here. The commercials have gone up. They were in this extreme long zone, and meanwhile, the non-commercials were down here in the extreme sell zone. But you see what's happening now. They're coming out of those zones. Usually, if you go back and you backtest, again, nothing is 100%, you will find that as they come out of these zones, the direction that they're coming out of is where, is basically for the non-commercials is the direction that price is going to go. And for the producers, it's the opposite because they're opposite of each other. So what do I mean? The non-commercials were in this extreme short position. They're coming out and they're lifting their shorts. Well, what do you think that's going to do? It's going to push prices higher. So they now have crossed. So we'll see tomorrow when the report comes out. If this line moves up even more, that to me, that'll be a great confirmation. Okay. If this turns and comes back down inside underneath this red line, then I might question it a little bit. But if we get a further push tomorrow, then I'm going to be pretty confident prices are going to go higher. And again, you'll find that the commercials, the prices will do just the opposite of what they're positioning. They're coming out of the extreme long and heading out. Again, that will push prices up. You can see the opposite happen right here. You have the commercials coming out of the extreme short position, and guess what? Prices went down. You have the non-commercials coming out of the long position, okay, and starting to sell, and prices came down, okay? Now, there can be a delay. This is why you can't just trade this in a vacuum. If you trade every signal like this, or as soon as it crosses out, if the non-commercials cross out of the extreme long position, you just sell blindly. The report comes out on Friday, you see that, boom, I sell. You may be in a world of hurt. It may work out, but you got to remember the battleship analogy. It could take, 1, 2, 3, 4 weeks. Price could continue to go up before it finally turns, but it will eventually turn in the direction they're pushing. Okay. It might happen right away. It might already be underway. You can see in this example, when it crossed out, when the non-commercials came out of this extreme long position, where does that line up to? It lines up with this big bearish candle that started that whole week. And it proceeded to go down for 1, 2, 3, 4, 5 weeks. Remember, these are weekly bars. So it doesn't look like much, but this is a weekly chart. And then we had a rally up for about 2 weeks. Okay. But where was their positioning all that time? They were still adding to their short positions. So even though the price went up, okay, the price eventually broke down, and then look how far it went down for weeks, okay, because they were still adding to their short positions. So this is what I mean about being confident that as long as you see that going on, that they're the ones that are driving the market. And of course, all that time, the commercials were heading higher, which means, remember, prices usually do the opposite. So again, confirms what we see here, that prices went lower. All right. And so I encourage you to go back and, back test this a little bit, because you'll see under some market conditions, it doesn't work that great. And on other ones, it's like textbook. But because of that, remember this, you have to still use your, your price structure and market structure and price action to find entries. You're not going to, because I know some of you are rolling your eyes and, oh, got a weekly chart. I don't trade on a weekly chart. Well, you don't have to. Once you've kind of identified where you think prices are going to go, you want to drop down to a shorter time frame. Then you're going to go down to your daily, your 4 hour, your 1 hour. And when you have kind of made that determination, like, oh, I only want to be short the market, then you can drop to your shorter time frame, okay, and start looking for entries. And the other thing that you're going to notice when you back test this is that the best signals are going to happen on this weekly chart when they're in the direction of the longer trend. So in other words, you can see this market is going down. So these down signals where the non-commercials are coming out of an extreme buy zone are better signals than going long when they come out of an extreme sell position. But it's not to say those aren't good signals either. Here's an example right here. The market's in a downtrend. The non-commercials come out of extreme sell, okay, right here. And the price does go up for 1, 2, 3, for about 2 months, okay? So you certainly could have traded this. But, just a note that, like anything else when it comes to trending, that the longer term trend is going to provide you the best signals, okay? So I did want to, point that out. All right. So I encourage you to back test it because it's going to vary by different markets on the soundness of these signals. Find ones that are, relatively smooth looking like corn is, where it pretty much happens in rhythm. Okay. Some of them are going to be very choppy. I found the wheat market to be very choppy. So I don't look at wheat anymore. For grains, I do soybeans and corn. And I think of those two, corn is the smoother one. Okay, so these are the ones I'm currently looking at. I have corn, soybeans, Euro futures, kind of throwing a currency in there. That's what 61, those are Euro futures. And then crude oil and natural gas. Okay, those are the markets I'm looking at. All right, and so that's how you basically can use this. Okay, and again, you're not taking trades off the weekly chart. Well, I guess you could, right? I mean, if you only want to trade a couple of times a year, then hey, then go for it. These are probably really good signals, and you just wait on the weekly chart, for something to happen, and you'd be good to go. But for those of you that want to trade them a little more often, then you just drop to your shorter time frame once you've established where the big players want to take the market. Now, let's say you miss in one of these areas where it comes out, because obviously coming out of one of these extreme areas is not going to happen all the time. That's fine. As we talked about right here, if the price is heading down, but it's in between these two extreme zones, that to me is trend continuation. So as long as these are heading down, all right, even though you might have missed when price first came out of here, all through here, you could be looking for shorts. Now, again, you can't just take this blindly because, like you said, we did see pullbacks in here, right? This pullback for 2 weeks here. We had a week here, it went up. All these light blue candles, these are all, pullback weeks. A week here, a week here, a week here, a week here. On the way down, like any other market, there's going to be pullbacks. But overall, obviously, the trend was down, right? Very clearly, you can see a downtrend on this market. And what was happening during that time, the non-commercials were shorting the market, and the market went down. But of course, there's always going to be pullbacks and retracements, like there is in any market, okay? So these are the ideal situations, in my opinion, where you can maybe catch the biggest moves when they start to come out of these extreme positions. But again, go to a shorter time frame and look for a good entry there. But these are the ones that you can potentially hold on to longer. But there is opportunity even in between these two zones is my point. All right. So I'm going to show you another website. It's going to pretty much give you the same data, but this adds, it's just a different view, and they add a seasonality component. So this is, I have no affiliation to this website, and most of it is free. Most of the data on here is free. You can register for a free account, and they do have like paid stuff on here if you want to sign up for coaching and have a subscription, and they'll work with you on this. but you don't have to do that, obviously. But it's insider-week.com. And like I said, I think you can even access it even without signing up for an account, but you can sign up for a free account. And so if we look at, let's go to the corn market on here. So what you do on here, you go to tools, you go to COT data, and it'll bring you to a screen that looks like this. And then I'm going to select corn. All right. And give it a minute to load. All right. There we go. Okay. There's your corn chart. And again, this is defaults. They only show you weekly on here. So this is the same weekly chart we were just looking at on TradingView. Now on this right here, this COT index is basically their version of what I just showed you on TradingView. But there's a couple of important notes. One, they only show you the producer commercial line, which is this red line. They're not showing you the non-commercials, and there's no option to add it, okay? So remember what I said is out of the extreme zone, price is probably going to go the opposite, okay? So now again, we're coming out of an extreme zone, heading down on for the commercials. That means if history follows, price should go up. And just like here, they come out of an extreme sell zone and heading up, okay, price goes down, okay? So important note, this is the producer commercial line. They don't give you an option for the non-commercial. So you have to think opposite when you look at this, okay? But other than that, it's pretty much the same. It's pretty much telling you the same data, okay? And then down here, they show you the actual, remember I was showing you on the CFTC website, those tables of the net positions that come out every week. That's what this is, okay? This is the actual running updated net positions based on the CFTC report, okay? So the red are commercials, the green are your non-commercials, and the blue are the small speculators, which they show down here, okay? So the latest dot, this was as of last week, September 2nd. You see that at the bottom of my screen. It says September 2nd in black and white because that was the last report. All right, so this is where they were positioned last week. Tomorrow afternoon, when the new report comes out, this will extend over. We'll get another weekly bar, and then this will say September 9th, okay? And all these numbers will update. And of course, you can go back in history and look. So these are the actual just plotting of the weekly report that comes out from this website. So it's basically taking these numbers up here for managed money, other reportables, and the commercials over here and plotting it onto this graph, okay? That's all it is. All right, and then they have the open interest down here, which again is the total number of open contracts, okay, for everybody. And you can see with corn, there's 1.5 million open contracts. So, all right. So the other thing that they add here, I was talking about seasonality. It's also under their tools. I have it open in a separate window, but you can go to seasonality. So I'm just going to open that window. And this is natural gas. Let me go to corn. And we'll look at corn. And you got to hit calculate. And then again, wait a second. Max Schultz, by the way, is the guy who started this website. I found him on YouTube. That's how I found this site. All right, so here's corn. This is the seasonal chart of corn. And you can see by the legend down here, the red line is this current year, which that's why it stops right here at this dot, because that's where we are right now. The blue is the 5-year average, whatever the color this is. I don't even know what that is. Some kind of dark green. Yeah, I guess it's green. 10-year average, and the 15-year average is this orange color. And what do you notice about seasonality for corn? Well, right around early to mid-August, the price bottoms, and seasonally, and this pretty much holds even through 15 years of price data, the market rallies through the end of the year. So what does that mean? Well, if you look at the COT data and the fact that the COT index is showing a potential of prices going long based on the commercials coming out of this extreme long position, or going back to TradingView to see the non-commercials lifting their short positions and starting to head long, that lines up with the seasonality. There you go. Now you've got a 1-2 punch that suggests that we could be in for an extended up move in corn just based on seasonal trends. So now you've combined seasonality with COT data. And so hopefully you can start to see the power of that. Now, it doesn't mean if you have COT data on your side but the seasonality doesn't match up, that doesn't necessarily mean you shouldn't take that trade, okay? Because as you can see, even within these years, there are times when, these are not smooth straight lines, right? There are times when they're not going to always agree. I mean, here's an area way back here where, in the current year, prices went up pretty aggressively here. And they went up on the other past years, but not nearly as much. And then you're going to find some years where they're opposite of each other. But for the most part, you can see, especially with something like corn, that it follows pretty much in line. Let me see if we can find one that maybe doesn't. Let's try like energy. Let me look at crude oil and just see if we get a different look with crude oil. Give this a minute to populate. Yeah, I mean, we have a little bit of difference here. Like, okay, so this year, again, we were heading down, down, down. In previous years, it basically trended up during that time, okay? And then we had, trending periods here, but in other years, it was going up, okay? So the seasonality is not necessarily a deal breaker, but if you can get those two things to line up, okay, for seasonality, especially if it happens consistently, like crude oil generally drops. You can see all of these time periods. Well, we don't know about this year yet because we haven't gotten there. But if history is any guide, by the time we get to early October, right about now, we should start seeing oil prices rise. But then we get to early October, and we generally see them sell off into like mid-December. So if we get COT data coming sometime like in the next few weeks to a month into October, suggesting that commercial traders and non-commercial traders are starting to point towards lower prices, that would line up with the seasonality. Now, of course, anything can blow that up, especially things like oil, like, international conflict, supply issues, regulation, anything that's going to change either the need for oil, supply and demand issues, exploration and, things like that. But, that's pretty much all accounted for in these fluctuations of these lines. Okay. But we're looking for general trends. So for crude oil, we're basically looking seasonally from about now until October. So about a month of price going up pretty aggressively and then starting to sell off. All right. So if we go back to the COT chart, let's go back to TradingView, and I'm just doing this on the fly, guys. So let's go to crude oil, and here's the weekly chart of crude oil. Now, right now, we've been pretty flat here. We've been essentially in a sideways market in crude oil here. I mean, again, I know this is a weekly chart, so there's a lot of variation inside of here, but overall, we're kind of flat to maybe trending down, okay? But if we look where we're at right now, okay, we have the non-commercials at basically an extreme short position. So if they start to now turn and come out of this zone, then that would suggest, that prices are may start turning higher. Now, if that happens, we'll see tomorrow. Then that kind of lines up with the crude oil seasonality of going higher. Okay, so we'll see what happens. Something to watch, right? Again, we will get some data tomorrow, and then, over the next couple of weeks, we'll start to see if, they start to come out of these extreme positions. The commercial start to come down, non-commercial start to come up. That could suggest that our seasonality is playing out. Okay, and so we'll see what happens. Now, understanding it's a short runway here. It looks like this only lasts, for about a month. where they kind of, run their prices up for a month and then they start to sell off. So we'd have to get this, pretty quickly here, but let's see how it turns out. All right. It's a good one to watch, right? It's a good test case. So that's using seasonality on top of the COT data. Now, I don't know if you can get seasonality on the chart in TradingView. I really didn't look. They do have some seasonality stuff down here in the lower left corner. There's seasonality here. This is obviously too small, in my opinion, to be useful. And it only gives the last couple of years, whereas this gives you, 5, 10, 15-year averages, which is going to give you a lot more data to look at instead of just like the last couple of years. So I would suggest using this. Again, it's free on this website, and there may be seasonal indicators in TradingView. I actually never really looked. Here's seasonality. I don't know what this gives you. Yeah, I mean, this is kind of useless. I mean, it goes back to 2015, but it's in a table form. That's really of no use to me. I don't know. This is Lux Algo. They do a lot of indicators, but I'm not sure how they calculate this. So whatever. I don't want to sit here and make the video too long anyway. So we're already at 40 minutes. So I want to wrap this up. So we will get rid of these. So if you want to use seasonality, then that's, just go to insider-week.com under tools and check it out. And there's a lot of other good stuff here too. But like I said, some of the stuff is premium you have to pay for. But the two main areas here are these two right here, right? COT data and seasonality. All right. And so it's pretty good. So that's what I wanted to go over today, guys. Commitment of traders. It's a good way just to see where the big boys are positioning, when they can, leave some breadcrumbs and kind of start hinting about when they might actually start making a turn and going the other way. And even if you miss the extreme area, you can still try to follow their ride on their back as they move towards another extreme at some point. Okay. Just remember, it's not a timing tool and it's not a trading strategy. It's a signal. It's a tool that you can use to help give you more confidence about the direction of the trades you're taking. But again, like always, you're still going to probably look for your entries on shorter time frames, and you're probably not taking trades off the weekly chart. I mean, the daily chart, maybe if you're a longer term swing trader, that would be perfectly acceptable. But if not, the 4 hour, the 1 hour, just like you do for any other analysis, once you know the direction you want to trade in, then you're going down to your shorter time frames to look for your entries. Okay. And just remember that sometimes it takes a while for these to play out. When that shift of direction can happen very slowly. Sometimes it happens quick on the first weekly candle of a change, but sometimes it can take a couple of weeks. And so, you might get frustrated and take some loss and say, oh, this isn't working. Well, it's because you're not giving it patience and you're just taking that just because it says to go short, but the market might not be ready to go short because they're still selling into a rally because they have to fill their positions slowly so they don't just blow the price out of the water and then, they get bad fill. So if they want the market to go short, they're going to start selling into the rally. And that could take time, depending how much liquidity is out there. That might happen in 1 week, or it could take several weeks. So just be patient, but it just helps give you that overall compass and direction about maybe where the big traders are going to take the market over the next several weeks or even months. Okay. As you can see, like under seasonality. All right. So I'm going to leave it there, guys. I'm at 45 minutes, way long, but I knew it would be. There's a lot here. But if you have any questions or comments, leave them down below. Poke around on these websites on cftc.gov or on Insider Week. There's other websites that show you the COT data too, but I think that's the best one. Barcharts.com is another one that you can look at, but it doesn't have the index. All right. I mean, they have these graphs with the raw data down here, but it doesn't have, it doesn't have the graphs or the index, and I don't think they have seasonality on here either. So to me, this is the best one to look at. But anyways, guys, I'll leave it there. Questions, comments, leave them down below. Smash that like button, subscribe to the channel, and I'll talk to you all soon. All right, take care. And we'll see when the new report comes out tomorrow if we get any insights into some of these other markets. All right, take care, guys.